Welcome to episode 19 of the Skadi podcast. This episode is the third and final episode of the Rogue Trader trilogy. So far we've looked at three major cases of rogue trading from the last 30 years, those being Leeson of Barings, Jerome Kerviel of SocGen and Kweku Adoboli of UBS. In this episode, we'll be looking at how instances of rogue trading might look different in the current wholesale financial markets, with a focus on the risks of business in transition, just like we've seen with the recent Credit Suisse UBS takeover. We hope you enjoy.
Hello and welcome back to our final episode of the Rogue Trader trilogy. Up until now, we've been discussing the cases of Leeson, Jerome Kerviel and Kweku Adoboli, and how they managed to rack up some monumental losses due to their unauthorised trading activities. Having learned from the mistakes of the past, it's now time to look ahead to the current climate in the wholesale financial markets and think about how we can avoid these catastrophic instances from occurring again. One of the key risks that can give rise to rogue trading that the experts at Skadi had identified is this business in transition scenario. As I'm sure most of you listeners are aware, recently in the news we've been hearing about one of the largest mergers in the last 20 years. That is the merger of the two Swiss banks, Credit Suisse and UBS. A further risk stems from this new working from home climate post-COVID, which brings with it its very own difficulties when it comes to keeping a watchful eye on those front office traders. We'll discuss all these potential risks in due course, but first, let's hear a small recap of our three major rogue trading cases. In one, most call him the original rogue trader, but to others, he's known as Leeson. Let's hear from Skadi's director Damian how he managed to make his name in the world of white-collar crime.
So, if we look at case study one, Leeson, probably the most famous of all, certainly in the UK, at Barings. Famously, he sunk Barings. In fact, of the three, he was the one that did the most damage, although his financial loss was in fact the smallest. It was enough to shutter what was at the time Britain's oldest merchant bank. His crime was to be trading, as you'll see it in all cases, all of these traders were trading futures mostly, and his desk was supposedly an arbitrage desk. He was looking to be buying contracts in one exchange or one market and selling the equivalent dollar amount of contracts on another exchange, and just taking the small discrepancy in price between these two to earn small profits for the bank. But as it turned out, this wasn't the case, and what he'd managed to do was take massive directional bets on the market by hiding a lot of the trades, famously in account 88888 that was set up. If you read the report, it's not clear whether he himself set it up or it was set up just as a pure error washing account, but he was very clever in the way that he was able to hide the reporting of this account through to his superiors in London and able to take big bets within this account. He was very hopeful that the volatility in the Japanese market, which was the one he was trading at the time, was very low at the time. So he was selling option strategies around this to try and take in massive amounts of money when markets weren't moving. And actually, what undid him was the earthquake in Kobe, which when it struck, caused a big sell-off in the market, which pushed him longer and longer in his positions, and he kept doubling up again to attempt to make the money back. And obviously, as we all know, this all unraveled rather spectacularly, and the dent that he put in Barings' balance sheet was enough to put them under. Leeson himself spent a bit of time in prison, and then himself became a minor celebrity, really. He appeared on Celebrity Big Brother, and bizarrely ended up becoming a manager of an Irish football team. Not sure where that fit into the story, but there you go.
In two, he now works in IT. It's the record holder for most money lost via rogue trading, SocGen's Jerome Kerviel. Over to you, Damian.
His rogue activity happened between 2005 and 2008. He was also arbitraging, looking to work on an arbitrage desk. He was on what was called the Delta One desk at SocGen, and this was supposed to be hedging out positions that SocGen had written they'd written structured products to send their clients called turbos. And the job of this desk was to hedge these positions so that SocGen theoretically had minimal risk to market movements as markets moved around the positions. In fact, a bit like Leeson, he was not arbitraging at all. He was taking huge bets. In fact, this was the largest of the three cases. He started small. He was, in fact, his first trade had been a profitable trade way back in 2005. He had shorted Allianz, the German insurer, during the London bombing attacks and made decent money on the trade, I think about 500,000 euros, for which he got a pat on the back, even though his desk were theoretically not supposed to be taking positions. I think that was an encouragement for him to carry on and carry on trading. And he built up what was a huge position in the futures market, absolutely humongous. I think by the time it unraveled, he had something like a $50 to $60 billion position in the futures market in Europe. So he was initially, when the fraud was discovered, he was told he would have to repay the full amount of it, the full 4.9 billion euros he would have to repay. So on his highest salary that he had earned during his time at SocGen, which I think was 100,000 euros a year, that would have taken him 49,000 years to repay. He famously went to meet the Pope to chat with him and then undertook a pilgrimage back, walking from Rome to Paris to protest against the tyranny of the markets.
And last but not least, in 3, our most recent case of rogue trading shenanigans. He spent the most time in prison before being deported back to Ghana. It's Kweku Adoboli of UBS.
He worked on what was called the Exchange Traded Fund, or ETF desk, which is also an arbitrage type desk, although this desk, unlike the other two, was allowed to have positions on its books. It had small trading limits, which did allow the bank to take small positions based around client flow and client business in the futures and ETFs market. What he was doing, though, as well, he had inside knowledge of how a lot of the systems worked. He was taking huge bets and not hedging them out on the other side. So he took bets to the tune of, I think it was up to about $10 billion. And when it unraveled, he cost UBS just over $2 billion, which was enough to cost the CEO at the time his job. He spent time in prison and was in fact deported to Ghana in November of 2018.
Thank you for that, Damian. So yes, these 3 cases represent the most high-profile cases of rogue trading in history, with losses being in the billions. However, one should not underestimate the power of rogue trading, even on a smaller scale. And this is why control functions within the financial institutions need to remain vigilant, no matter how small the firm. The Skadi podcast is a podcast primarily meant for audit, compliance and control functions within the wholesale financial markets. Its purpose is to give insights and provoke discussion that can help bring the frontline knowledge of the Skadi experts to practitioners in the second and third lines of defence. Now, with that in mind, we're going to move on to reflect on these 3 cases of rogue trading and how we can mitigate these risks in the current world of finance. So looking at each of these 3 cases, there is certainly one commonality that shines out. That is, all 3 of our famous rogue traders came from an operations background within their respective institutions. So let's see what the Skadi experts say on whether this type of progression still poses a threat in the modern world. So obviously one of the main ways that the 3 cases of rogue traders that we've looked at, the main ways that they have had success, inverted commas, in their rogue trading is because all 3 of them came from an operations background. Leeson, I think, definitely did. Kweku started off at UBS and then, in a summer internship in operations. So is there still a risk of that kind of progression from operations to front office and those people being able to exploit that knowledge within kind of modern modern banking systems, financial institutions.
It's an interesting point, because if we look at this from a cultural perspective, if you're working perhaps in operations or perhaps in the middle office, perhaps you're on the dealing floor already, and you're working for the traders and the salespeople, a lot of people in those positions want to progress to become a trader, to become a salesperson, to get into the front office. And the interesting point with that is that can create a situation whereby someone that's eager to get into that position, could they be assisting somebody in the front office? Could they be amending trades, touching trades? Could they be, doing things they shouldn't be in order to try and get that progression into the front office? It's certainly a risk that's worth considering in this instance.
I think that's a good point. I think generally I would say it's harder to progress from an operational background into the trading background now than it was back then. Certainly back in the 90s, 95, early 2000s. But I think Dave's point is a valid one. I think because traders always want operations to focus on their customer trades first. They want to get the minimal of settlement failures, and they want a very happy client at the end of the day to give them more business and trade more often. So they will be often subconsciously putting undue pressure onto the operational side of things, and somebody with ambitions to move into the front office may well overlook other trading activity to focus on their preferred traders, clients, and move down that area. But I think in general, in all these cases, having a knowledge of operational systems was an advantage when they set about their rogue trading activities, because they had a front to back view of the whole business. They knew what would be red flags that would be taken seriously and acted on in a timely manner, maybe which red flags may get overlooked for a longer period of time.
Yeah, and David, as you know, a lot of what happens in operations is on a cycle. There are certain cut-offs when certain reports are run, when certain reconciliations have to be done. So I remember you would sort of say to me, we have to get our instructions in by such a time.
Exactly.
Because we need to do it before the batch or whatever it happens to be, or I haven't got time, the batch is about to be run, all that kind of stuff. And it's that kind of knowledge which means that you can circumvent controls. Because if you know when batches are run, if you know when cycles are getting entered into, if you know when to enter trades and then cancel them later so that they don't show up in risk reports, and that kind of information it's possible to come across it in the front office, but you're really at the sharp end if you're in operations. So if you come from operations into the front office with all of that knowledge, that's really where you can really cause problems and cause benefit to yourself. And in the case of all three of them, what's really stark is how quickly they all undertook their rogue activity, because they knew when things happened and what they had to do. I think that's my personal view as to why it happened so quickly. Whereas if other people were approaching it that didn't have that knowledge, then of course there's a time lag as they try and learn and find out this information, but it also may not come to them because there are certain things that just aren't transparent as they would be in operations.
With regards to separation of duties, you'd like to think optimistically that the risks that were there in the 90s just aren't there anymore. Leeson was in charge of the back office for a time and the trading activities at the same time in Singapore, and you'd like to think that wouldn't be a risk that's around in major institutions today. But
Well, I think in major institutions you're right, Martin, but in small ones, then that can be a problem, because that can happen. And in small institutions, it doesn't take much to destroy the capital. I recall having a guy on the graduate scheme at one of the banks that I worked at, who later went on to rogue trade over a £5 million position, and that put the firm he was working out of business because he wasn't allowed to take positions, but he did, and that resulted in, I think, 20 people or so losing their livelihoods.
Wow.
That's the real impact of rogue trading. And he was given a jail term, even though it was, by comparison to the likes of Leeson and Adoboli, these were, it was a very small sum of money, but the impact on people was every bit as large. You're listening to the Skadi podcast. Skadi are the financial experts. Our deep understanding of complex financial products and front office expertise give us the ability to ask the right questions for you and solve the problems other subject matter experts cannot see at speed. Whether we've worked as traders or in operations, everyone you'll speak to at Skadi has frontline knowledge and a deep understanding of financial products. We share our practical financial knowledge, analysis, focus and clear thinking, and we communicate with clarity. We're proudly multilingual. We take great care to make our findings accessible so you feel confident, you understand what's happening when and why. Skadi, the financial experts.
Another commonality from these three cases is this idea of businesses in transition. In the case of Leeson, we had the move of Barings to ING after the great sell-off from the Kobe earthquake. Kerviel's era saw the effects of the global financial crisis change the world of banking, and Adoboli's activities cost the CEO of UBS and a few other high-ranking professionals their job in the wake of the great financial crisis. Without a doubt, the uncertainty and the loss of complacency that arises from business in transition can heighten the risk of rogue trading. So what kinds of business in transition have we seen recently?
The new norm is working from home. I mean, you cannot argue that we haven't lived through the largest business transition the world has ever seen, really. Each of the three individual cases we talk about were transitions within their individual banks, but this is a mass change to working practices and people working from home. Are they sitting on secure networks? They may be logging into secure accounts into banks that they're working at to be able to go about their daily activity, but could people hack into their systems and then hack through to their banks? I cannot stress enough, business in transition was a red flag for all three of the cases that we've seen, and we definitely live in different times now, and massive business disruption that we've seen. And also think about what's happened to some banks would have had staff furloughed. Some people might have been doing one job and now they're doing another, or maybe having to cover for somebody else. A lot of things were put in place when lockdown occurred to allow businesses to continue working, and hopefully a lot of these have been unwound and strict controls have been put back in place. But the chances for rogue trading in this sort of environment, in my view, have increased massively.
Indeed, the post-COVID world of work has left business with a brand new way of doing things. And whilst this may be beneficial in some aspects, as with everything, there are bound to be risks that come along with it. As Damian highlighted there, the new work from home era has meant that many people will now have access to systems and such from the very comfort of their living room. Not to mention the fact that it might be even easier now for individuals to avoid confrontations with other workers in their firms, since they're no longer all in one place, in one office. So looking at more recent times, we've perhaps seen one of the largest examples of business in transition for quite some time. I'm referring, of course, to the merger between Credit Suisse and UBS, which stemmed from the banking turmoil that started off with the collapse of Silicon Valley Bank. As one might imagine, there are various difficulties when it comes to mitigating front office risk that can arise from the merging of two huge companies. Where to allocate different personnel, who gets oversight over which books, whose systems and practices will they use in specific areas. Let's take a look now with some of Skadi's financial experts at the key considerations for a merger as large as this, with respect to our other rogue trading cases.
So when you're putting two organizations together, what are the challenges?
Well, we looked at the three circumstances, the high-profile ones, Kweku, Kerviel, and Leeson. And one of the key factors in all of those cases was where you have a business in transition. And of course, where you're bringing two organisations together, that's the biggest transition you could possibly have. And what happens on the ground is that you have changes to reporting lines, and that can be really important because you can have geographical changes where you have people that have a local manager but perhaps a regional manager or a global manager, and that can change, and it can be someone from outside of the organisation. So if you were in Barings, you might end up working for someone in ING and vice versa. And of course, if you think back to the nature of those two businesses, they were pretty different. But people will make short-term political decisions to kind of create some security around staff, because the last thing you want when there is a change and you've just acquired a business is for all the staff to clear off. When you've just acquired a business, obviously you want the assets, but you need the people. The people are part of the assets and part of the strength of that business. So you will make political decisions to show that you're committed to that organisation. That could have bad consequences, because you could have a manager potentially that doesn't actually have familiarity with the products that are being traded. It's a rarity, but it happens. And in a case like ING and Barings, I'm not going to give you examples of where that happened, but you could see where you have one that's predominantly a bank and one that's predominantly a brokerage. They're two very, very different businesses. And so you will have problems there. In the case of Kweku Adoboli, I seem to remember that he had managers that changed. And for a long period of time, he had a manager that wasn't even aware of his reporting line through to him. So there was a sort of lack of ownership. And these are the kind of things that happen where you may have things that fall through the gaps. So in the case of Leeson, who was out in Singapore, it wasn't really clear where his reporting lines were, whether they were to Barings Securities, whether they were to Baring Brothers. He was part of Baring Futures. These were all different businesses. And then, of course, he was out in a region out in Asia, far away from the London time zone where everything was headquartered. So his reporting lines weren't well defined, and that gave him opportunities. So a merger certainly is one of the biggest situations where you get a business in transition. I've talked about things that happen in the front office, but David, you've been through a few different changes in your career. What happens at the back end? What can happen?
Well, there's several things, isn't there? There's different systems being integrated, and there's the different people, different trading teams as well. And from the operations side, you kind of find out about this when the tickets are printed, when you're processing the tickets. So you're on the hop. You're trying to figure this out as and when this is coming through the plumbing of the financial markets. You're having to quickly act in order to be able to get everything settled on time. And of course, there's the tremendous risk that's created here with all this happening with different systems, different teams coming together. The margin for error is increased dramatically.
I think also what has been evidenced in some of these cases too is where you've had a business that's growing successfully, generating revenue, and so there's an immediate response from management to beef up the front side because they want to make more money, and it takes time for the operational side to follow through and have that corresponding investment.
Exactly.
And that can cause real strains and problems.
Exactly, yes, it certainly can. Nobody wants to find out the hard way in that scenario.
And I think the point you make about systems is a really key one, because we see that in pretty much all of the organisations that we work in. You still have legacy systems which cause real problems within institutions. It can lead to people having to make fixes, double key things where they have one particular system that can't talk to another, or they may be trading a set of products which are hedged with other products, which means that they can't be booked in the same system, that kind of thing too.
Exactly, different products being shoehorned into systems that don't really fit, but it's all having to be done so quickly and pushed through without being managed and tested in a controlled manner, which you really need.
And new products and systems that are outside the scope for the current surveillance capabilities of the firm, and then the firm may then have to go and find a new provider, and look to bolt on bits and pieces to make sure they're covering all the activity. But these things take time, and there's opportunity there where gaps occur.
Definitely some really important considerations in that discussion when it comes to businesses in transition. Without a doubt, transitions like mergers have a tendency to throw things into disarray for a short period of time, which can heighten the risk for unauthorised activity to slip past control functions unnoticed. But of course, business won't wait for the necessary changes to be made and settled. So in times like these, it's important to have a clear plan that allows you to have full line of sight over the kinds of activities that are taking place.
You've been listening to the Skadi podcast. This episode was the final part of the Rogue Trading Chronicles, where we've been discussing the rogue trading activities of Nick Leeson, Jerome Kerviel and Kweku Adoboli. On the discussion panel today was Nick Corry, Damian Taylor, Martin Anthony and David Bridges, with research and interviews carried out by Coleman, Corry and Alexandra Mexi. If you want to listen to more episodes, just find us by searching the Skadi podcast on any streaming platform, and feel free to connect to us at Skadi Limited on LinkedIn to read about our research and business relating to anti-financial crime and control functions. Thank you for listening.